Now, when you just get into a market, it's normal to not have any clue on what to do. We need some clarity. And the way a market's price action becomes more clear is when you have nailed the directional analysis. What we look on the directional analysis is to connect the swing points so we know with detail what the market has done recently and what it's likely to be doing next. On this market, the price starts from a low into a high, and then from this high, the price went down for a bit, but then it flipped again into going up. The extremely important part of this price action is the fact the price has pushed up and broken above the last high. The reason this matters a lot is because when the last high breaks into a new high, that signals that the price action is following an uptrend. And why is it important to know that we are in an uptrend? Because if we know that we are in an uptrend, we know that we look for support or demand levels on the downside pullbacks, and to be more exact, usually a support or demand will be found as the last downside candle before the price started pushing up. And it's very important for that upside push to be the cause of the price breaking above the last high, because it's the break above the last high, the action that validates the demand or support. Without the price breaking above the last high, the chances will decrease for a demand or support to hold the price up into an uptrend. But in this case, we see that the demand was valid because of the upside break, as we also call it as a break of structure. And the simplest setup planning from these support or demand levels are straight entry buy setups from them, with the stop loss below the last low, because on an uptrend, we want the next low to end higher than the last one. So in other words, the next low should not break below the last low. But what it should break is the last high. So a break into a higher high. And that's why the take profit is placed above the last high. But make sure to position it to at least a 1-to-2 risk-reward ratio. It could be slightly more than that, but I wouldn't go for less than 1-to-2. I say this in many of the videos because you see that it respects well, just like in this case. Because from the recent high, the price pulls back down to form a low, and that low, as we can see, ends on a demand taken from the previous low. So this new low ended above the last low, then the price bounced up from the demand, breaking above the last high. And if we have a break of the last high, so a break of structure to the upside, that break itself should validate another demand or support level taken from the previous low. More exactly from the last downside candle before the market started pushing up, with that push being the one that caused the price break above the last high. And this leaves a demand or support level, but in this case, we see that this level didn't fill, and the market kept going without it. It kept going by pulling back down, but this pullback ending above the last support or demand level, before eventually it kept pushing up. So we see that this time, a buy setup from this demand would not end on a win, neither on a loss, but the setup would have just not get opened, and that shouldn't be a problem, as many of these levels will not fill, but that shouldn't stop you from looking for more opportunities. So we had this pullback to the downside, which was later followed with a significant upside action. And this breaks above the last high. So if we have the break of structure to the upside, that means that we validate another support or demand level. And that level is found near the last low, before the price pushed up, with that push causing the break of structure. And the support or demand level, to be more exact, is the last downside candle before that upside impulse. And in this case, if we position a buy setup from this recent demand level, of course with the stop loss below the level, and take profit at around a 1-to-2 ratio. And in this specific case, it's hard to get the take profit target above the last high. That's because the risk reward will increase too much. But a 1-to-2 ratio is often a standard one, which is not too risky, but also not too safe. So with this placement, you're not too greedy, but also not too scared. However, again, what happened next is that the downside pullback again has ended above the demand, not filling the level. And that means that the setup is still not opened. And the mistake some traders might make in this case is that they keep the position until it gets opened, but they do so without reading what happens to the price action. Because here, for example, after this pullback has ended, the price started pushing up to form a high. And from that high, the market drops back down. So it's really important to notice the swing points the market has just created recently, because we have the highest swing point, so of course, a high. But then the next high is actually lower than the last high. So this last high is a lower high swing point. Pay close attention to the swing points the market had, if you notice. Each high ended higher than the last one, in a chain that is named as a repeated higher high swing point. But now we have the first lower high. And also if we look at the lower swing points, each low was also higher than the last low, in a chain that we call it as being a repeated higher low swing point. But now the last low has broken down with the price ending below the last low, this being the first lower low swing point. The breakdown of the first higher low into a lower low, that first break is a trend shift from the previous trend, which was an uptrend since we know that on uptrends we had those higher high and higher low swing points, into a trend reversal entering a downtrend, and a downtrend has swing points of a lower low, and we already have the first one right now that is then followed with a lower high, and a downtrend is the repetition of this price action pattern. Now, if the market could enter into a downtrend, then buying positions no longer make sense, but what would rather make sense are selling positions, and on downtrends we look for selling opportunities on the previous highs. Because if a downtrend has formations of a lower high, then it's in our best interest to sell at the highest price we can. But these selling positions are not opened randomly. They are usually done from resistance or supply levels that are taken from those last highs, and to be more exact, from the last upside candle before the market started pushing down, with that push being the cause of the break of structure below the low, or in this case, the cause of the trend change into a downtrend. And it's from this level where we position the sell setup, with its entry on the bottom of the level, stop loss above the last lower high, in an expectation of another lower high, but lower than this one. And now on the take profit, it's where it really shows who did the entire price action analysis and who skipped to the last part, because usually on a downtrend, the take profit is placed below the last low, but most forget about the demand levels that are still unfilled and they can still be valid. For example, this upper demand can still shift the downtrend into an uptrend. Right now, the market is in a downtrend because we see the recent swing points are swing points of a downtrend. But this downtrend can come to an end after hitting a support or demand level, and that's why a strategic placement of the take profit is on an unfilled demand or support level from the left, levels that most have forgotten about. This way, if the market bounces from the demand, it won't affect you negatively, because you're already out of the setup, hopefully on the take profit getting hit. And on the other scenario, where the demand breaks and the downtrend keeps going, well, you still have hit the same take profit target. Could you have got more out of the position in this case? Yes, you could have, but that's why I always mention that you shouldn't greed out too much, and look to target between 1 to 2 and 1 to 3 risk-reward ratio, because in most cases, you don't need more than that, and in most cases, you won't need less than that. So let's see what happened. From the first lower low swing point, the price begins to pull up and that hits the supply, opening the sell position, and after marking a high, the price very quickly rejects back down from the supply. On a quite aggressive downside candle, this downside action closing the sell setup on the take profit, and also breaking below the demand, and even breaking the other demand from below. So yes, with a higher risk-reward ratio. So basically, if we would look to target for a wider take profit, we could have gotten more out of this setup. But you never know if one of those unfilled demand or support levels can actually shift the trend. And in that case, if we greed out too much, there are way higher chances that we're going to lose the setup. So keep in mind, take out a simple win and get out without regrets. And again, we start the same way, with the directional analysis, and we connect the swing points. And on the beginning of this market, we got an uptrend pattern of an upside impulse, followed with a downside pullback, continued with another upside impulse, with this last impulse breaking above the last high. The break above the last high will validate a support or demand level from the last low, and that should be the last downside candle before the market started going up. And that upside movement must be the one that caused the break above the last high. And again, this demand was left behind because the next pullback ended way above the demand. But what actually matters is from what happened next. Because the uptrend kept going with another upside movement, and this breaks above the last high. And so as I said, the break above the last high will validate a demand, and that demand is found on the last low. And to be more specific, the demand level is the last downside candle before the price started the upside push, with that push breaking above the last high. And we found the demand, but we see that the price is broken below the demand. So a buying setup would have ended as a losing setup, because from the swing high, the price pushed down, and this push to the downside has hit the stop loss placement. So this, of course, invalidates this demand. But that's not all, because if we look at the lower swing points, the last low has broken down, and the price has created the first lower low swing point. And we know that the first break below the low is a trend change from a previous uptrend into a likely upcoming downtrend. On a downtrend, we will most likely have a lower low, the first one being right here, that is then coupled with a lower high. And after a lower high, we should see a lower low, then another lower high. So basically, a downtrend is just a repetition of these two swing points. The reason we need to know this is because on a downtrend, we look for selling positions. And these selling positions are taken from resistance and supply levels, which they are the last upside candle before the market started going down. But if you carefully look at the price action, there might be some trouble. Look at where the price is right now. If you have done the directional analysis from the very beginning, you would see that the price is right now sitting on the demand that was left behind. And we also see on the last candle after the demand has been hit, that last candle looks like it's bouncing up from the demand. And now it's where it becomes complicated, because what level should you trust? Should we trust the supply, or should we trust the demand? Well, truly nobody can know with certainty, and when you find yourself in this situation where the demand fills first, you could buy this demand, but must be very careful with the take profit placement, because that take profit should at most be placed on the bottom of the supply. This way, even if this demand will later fail and break down, it won't matter because you're hopefully already out of the setup on a win. And of course, there's the other scenario where this demand just breaks down instantly, and in this scenario you get stopped out. But assuming you're managing a decent risk-reward ratio, a losing setup will not hurt in the long run. And in this case, the supply instantly got broken, so of course with a buy setup from the demand, targeting the bottom level of the supply, with this simple placement, the setup would have ended on the take profit, no matter if the market kept going up or no matter if the market would have pushed down from the supply. In both scenarios, you get out of the setup before any danger can strike you. Now, I simplified as much as I could on such a short video, but I highly suggest you watch more of our content because you see that this analysis is simple, and it's not only about doing the right things, but also about avoiding the mistakes. And we also have on the program linked in the description a full guide on it.